Blockchain and cryptocurrency did not begin as a technology looking for a problem. They emerged from an economic system that had already begun to fracture under its own weight. Long before code entered the conversation, the deeper issue was trust: who controlled it, who benefited from it, and who absorbed the consequences when it failed. By the early 2000s, the global financial system had settled into a familiar shape. Central banks controlled the issuance of money and interest rates. Commercial banks acted as intermediaries, custodians, and lenders. Clearinghouses quietly managed settlement behind the scenes. National currencies were backed not by commodities, but by state authority and confidence. On the surface, this system appeared stable. Beneath it, however, were growing distortions that most participants could not see and had no ability to audit. Money had become abstract in a very specific way. Individuals interacted with balances on screens, but those balances represented layered promises, bank liabilities backed by institutional trust, legal frameworks, and political stability. For everyday users, the system demanded trust without transparency. Depositors trusted banks. Banks trusted other banks. Central banks trusted models. Governments trusted that confidence would hold. At every layer, decision-making power was concentrated, while risk flowed outward. This imbalance produced a quiet but persistent tension. Institutions operated with opacity and protection, while individuals were monitored, regulated, and penalized for small failures. The system worked efficiently during calm periods, but its design assumed that trust would always be justified. It offered no structural mechanism for skepticism. There was no way to independently verify the integrity of the system without being inside it. That tension became impossible to ignore during the 2008 global financial crisis. What had previously been theoretical suddenly became visceral. Banks that appeared solvent were revealed to be deeply leveraged. Losses that originated within private institutions were transferred outward to the public. Central banks expanded money supply at unprecedented scale to prevent total collapse. For ordinary savers, the costs arrived indirectly through inflation, wage stagnation, and fiscal austerity. The crisis exposed a core economic reality that had long been obscured. Money was not neutral infrastructure. It was a political and institutional instrument shaped by incentives, power, and discretion. Trust, once broken, could only be restored through authority, not transparency. For a small but growing group of technologists and economists, this was not a temporary failure. It was a design flaw. Long before Bitcoin existed, cryptographers had been grappling with this problem. The cypherpunk movement was built around a simple belief that privacy, verification, and voluntary coordination were essential for functional markets. They had experimented with digital cash systems for decades, but every attempt failed for the same reason. Each system relied on a central issuer. That issuer became a point of control, and eventually a point of failure. The unresolved challenge was not digital money. It was digital scarcity without centralized authority. In 2008, an individual or group operating under the pseudonym Satoshi Nakamoto proposed a solution that combined cryptography, game theory, and economic incentives into a single structure. The proposal described a system where money issuance followed a fixed, transparent schedule, where ownership could be verified by anyone, and where trust emerged not from institutions, but from computation and consensus. This system became Bitcoin. From an economic standpoint, Bitcoin was radical not because it was digital, but because it challenged foundational assumptions. It rejected the idea that money must be issued by states, that settlement requires trusted intermediaries, and that scarcity must be enforced by authority. Instead, it offered algorithmic issuance, distributed verification, and cryptographic ownership, secured by economic incentives rather than legal enforcement. Bitcoin was not designed to be efficient in the conventional sense. It was designed to minimize trust. Its slow settlement, limited throughput, and rigid monetary policy were features, not bugs. They were trade-offs chosen deliberately to reduce discretionary power and eliminate single points of failure. Embedded in Bitcoin's first block was a quiet but unmistakable signal, a reference to bank bailouts that made its motivation explicit. This was not an upgrade to the existing system. It was a parallel experiment. One that asked whether money could exist without permission, whether verification could replace authority, and whether economic rules could be enforced by code rather than institutions. Bitcoin did not arrive to solve inflation or payments or speculation. It arrived because confidence in the existing monetary architecture had fractured, and no internal reform seemed capable of repairing it. The question Bitcoin raised was not whether it would succeed. It was whether money itself needed to change. To understand blockchain, it helps to let go of the idea that it is primarily a currency system. At its core, blockchain is a new way of maintaining a ledger, a shared record of who owns what, without assigning that responsibility to any single authority. Bitcoin simply happens to be the first successful economic system built on top of that idea. In traditional finance, ledgers live inside institutions. Banks maintain internal databases that record balances. Clearinghouses reconcile transfers between those databases. Final settlement occurs when trusted parties agree that the numbers now match. The entire system functions because certain entities are granted the right to declare the ledger true. Blockchain replaces this institutional authority with a public process. In Bitcoin, the ledger is distributed across thousands of independent computers, known as nodes. Each node maintains a complete or partial copy of the transaction history. No single node is special. No node is trusted more than another. What matters is not who records the data, but whether the data follows the rules of the system. Every Bitcoin transaction is a statement. One set of cryptographic keys authorizes the transfer of a specific amount of Bitcoin to another set of keys. These keys do not represent identities. They represent control. Ownership in Bitcoin is defined entirely by the ability to produce a valid cryptographic signature. When a transaction is created, it is broadcast to the network. Nodes independently verify that it obeys the rules, the signature is valid, the funds exist, and those funds have not already been spent. This last condition, the prevention of double spending, is the central problem blockchain was designed to solve. Instead of trusting a central ledger to prevent double spending, Bitcoin batches transactions into blocks. Each block contains a list of recent transactions, a reference to the previous block, and a cryptographic fingerprint, called a hash, that uniquely represents its contents. By linking each block to the one before it, Bitcoin creates a chain where altering any past transaction would require rewriting every block that follows. This is where computation enters the economic picture. To add a new block to the chain, participants known as miners must perform a specific kind of computational work. They repeatedly hash the contents of a proposed block, adjusting a small variable each time, until they produce a hash that meets a network-wide difficulty target. This process is called proof of work. The work itself has no intrinsic meaning. What matters is that it is expensive to perform and easy to verify. Any node can instantly check whether a block's hash satisfies the difficulty requirement. But producing that hash requires real-world resources, electricity, hardware, and time. From an economic perspective, proof of work transforms energy into security. It makes rewriting the ledger prohibitively costly. To alter transaction history, an attacker would need to control more computational power than the rest of the network combined, and sustain that dominance long enough to outpace honest participants. The cost of attack scales with the value being protected. When a miner successfully produces a valid block, it is broadcast to the network. Other nodes verify it independently. If the block follows the rules, it is added to their copy of the ledger. Consensus emerges not because nodes agree in advance, but because following the rules is economically rational. Importantly, Bitcoin does not guarantee instant finality. Multiple miners can produce competing blocks at nearly the same time, creating temporary forks in the chain. The network resolves this by adopting the longest chain, the one with the most accumulated proof of work, as the authoritative history. Over time, as more blocks are added, earlier transactions become increasingly difficult to reverse. This probabilistic finality is a deliberate design choice. It trades speed and certainty for resilience and decentralization. In Bitcoin, settlement is slow by modern payment standards, but it is exceptionally difficult to censor or undo once confirmed. The monetary layer is embedded directly into this process. New Bitcoin are issued as part of the block reward paid to miners. This issuance follows a fixed schedule, with the reward decreasing roughly every 4 years until it asymptotically reaches zero. There is no committee adjusting supply. There is no emergency lever. Monetary policy is enforced by code and verified by every node. Economically, this creates a system where security, issuance, and settlement are inseparable. Miners are incentivized to act honestly because they are paid in an asset whose value depends on the credibility of the ledger they are maintaining. Nodes enforce the rules because deviating from them isolates them from the network. Blockchain, in this sense, is not trustless. It is trust minimized. It does not eliminate incentives or self-interest. It harnesses them. By the end of this process, something subtle but profound has occurred. A ledger exists that no one controls, yet everyone can verify. Transactions settle without permission. Ownership is enforced without courts. Scarcity is maintained without authority. This is the mechanical foundation on which the entire cryptocurrency ecosystem rests. In Segment 3, we'll expand outward from Bitcoin and examine how this underlying mechanism evolved into programmable blockchains, smart contracts, and decentralized finance, and why those extensions introduced new economic possibilities as well as new risks. Bitcoin demonstrated that a decentralized ledger could exist without institutional control, but it was intentionally narrow in scope. It did one thing: secure, permissionless monetary transfer, and did it conservatively. That restraint was not accidental. Bitcoin's design prioritized predictability and resilience over flexibility. As a result, it proved the concept of blockchain, but it also revealed its limits. Very quickly, a new question emerged. If a blockchain can enforce rules about money, could it enforce rules about anything? This question marked the transition from cryptocurrency as digital cash to blockchain as a programmable economic platform. The next major leap came with Ethereum, which reframed the blockchain not just as a ledger, but as a global execution environment. Instead of recording only transactions, Ethereum allowed code itself to live on the chain. These programs, known as smart contracts, automatically executed when predefined conditions were met. From an economic perspective, this was a profound shift. Smart contracts removed not just intermediaries, but entire categories of coordination cost. Agreements that previously required lawyers, escrow services, compliance departments, and enforcement mechanisms could now be expressed directly in code. Once deployed, a smart contract would execute exactly as written, regardless of intent, context, or changing circumstances. This rigidity was both the promise and the danger. Smart contracts made it possible to create decentralized exchanges, lending platforms, derivatives, insurance pools, and governance systems without centralized operators. Users interacted directly with code. Assets moved automatically. Rules were transparent and verifiable. In theory, this reduced counterparty risk and eliminated discretionary interference. But it also introduced a new kind of fragility. Code has no judgment. Bugs became exploits. Ambiguity became impossible. Economic logic that worked on paper often behaved unpredictably at scale. When errors occurred, there was no court to appeal to, only the chain. This tension became visible early when a major smart contract failure forced Ethereum's community to choose between immutability and intervention. The decision to alter the ledger exposed a central contradiction. Even decentralized systems rely on social consensus in moments of crisis. Code could automate rules, but could not fully escape human governance. As programmable blockchains proliferated, so did experimentation. Entire financial systems began forming on-chain under the umbrella term decentralized finance, or DeFi. These systems recreated familiar financial functions, borrowing, lending, trading, leverage, but without traditional institutions. Liquidity was provided by users. Interest rates adjusted algorithmically. Collateral was locked in smart contracts rather than held by banks. Economically, DeFi compressed financial infrastructure into software. Balance sheets became public. Settlement occurred continuously. Risk moved faster and more transparently, but also more violently. Without lenders of last resort or regulatory circuit breakers, small shocks could cascade into liquidations within minutes. At the same time, new digital assets emerged that were not primarily monetary. Tokens came to represent governance rights, access privileges, claims on future revenue, or purely speculative instruments. The distinction between currency, equity, and commodity blurred. In many cases, it disappeared entirely. This expansion transformed blockchain from a monetary experiment into a broader economic laboratory. But it also diluted Bitcoin's original thesis. Where Bitcoin minimized complexity to preserve trustlessness, programmable blockchains embrace complexity to maximize functionality. That complexity introduced new dependencies, software updates, developer leadership, foundation governance, and informal power structures. By the mid-2010s, crypto was no longer a single idea. It had become an ecosystem of competing economic philosophies. Some chains optimized for decentralization. Others optimized for speed. Some prioritized immutability. Others prioritized adaptability. Each design choice reflected trade-offs between efficiency, security, and control. From an economic standpoint, this diversification mirrored early industrial capitalism. Rapid innovation outpaced institutional understanding. Experiments proliferated faster than failures could be analyzed. Capital flowed aggressively into systems that promised automation, yield, and disintermediation, often without fully accounting for risk. Blockchain had evolved from a critique of finance into a parallel financial universe, one that replicated many of the same incentives, asymmetries, and fragilities it initially sought to escape. In Segment 4, we'll examine how this new crypto-financial system began interacting with the real economy through speculation, capital flows, institutional adoption, and regulatory response, and why its impact has been uneven, cyclical, and deeply contested. For its first few years, cryptocurrency existed largely at the margins of the global economy. It was discussed in forums, mined on personal computers, and dismissed by most financial institutions as a curiosity or a threat. But as programmable blockchains expanded what crypto could do, the boundary between the crypto economy and the real economy began to erode. The point of contact was capital. Once crypto assets could be traded easily, priced continuously, and stored digitally, they became investable. Exchanges emerged that allowed national currencies to flow directly into crypto markets. This transformed blockchain from a technical experiment into a speculative arena, where prices responded not just to utility, but to narrative, momentum, and liquidity. From an economic perspective, this was the moment crypto became cyclical. Capital entering crypto did not arrive evenly. It arrived in waves. Periods of rising prices attracted new participants, which increased demand, which pushed prices higher still. These feedback loops were amplified by leverage, derivatives, and the psychological dynamics of speculative markets. When confidence reversed, capital exited just as quickly, often faster, producing sharp collapses. These boom and bust cycles were not accidental. They were structural. Crypto markets operated continuously, globally, and with minimal friction. There were no trading halts, no central banks providing liquidity backstops, and no mandated disclosure standards comparable to public equities. Information asymmetry was extreme, and market participants ranged from highly sophisticated firms to retail investors encountering financial markets for the first time. At the same time, crypto began absorbing real economic functions. Stablecoins, digital tokens pegged to national currencies, allowed users to move dollar-equivalent value across borders instantly. For individuals in countries with volatile currencies or capital controls, this was not speculative. It was practical. Crypto rails quietly became a shadow payments infrastructure, operating alongside traditional banking systems rather than replacing them. This dual role, speculative asset on one hand, functional infrastructure on the other, created persistent confusion about what crypto actually was. Policymakers struggled to classify it. Was it money? A commodity? A security? Each answer implied a different regulatory framework, and none fit cleanly. As prices rose, institutional capital followed. Hedge funds, family offices, and eventually public companies entered the space. Mining became industrialized. Custody became professionalized. Financial products were built to provide exposure without direct ownership. Crypto began to resemble the very financial system it once critiqued, complete with intermediaries, concentration, and systemic risk. Yet the underlying infrastructure remained different. Settlements still occurred on public blockchains. Transparency was still radically higher than in traditional finance. Failures were visible in real time. When crypto institutions collapsed, there were no quiet rescues. Balance sheets unraveled publicly, transaction by transaction. This visibility had economic consequences. Trust was no longer assumed, it was priced. Assets associated with opaque behavior or weak governance were punished faster and more severely. At the same time, narratives often overwhelmed fundamentals. Tokens with little economic function could reach enormous valuations, while useful infrastructure remained undervalued. Regulators responded unevenly. Some jurisdictions attempted outright bans. Others embraced crypto as a competitive advantage. Many adopted a wait-and-see approach, intervening only after major failures. This regulatory fragmentation encouraged jurisdictional arbitrage, where capital and projects flowed to regions with the least friction rather than the strongest foundations. By this stage, crypto was no longer external to the economy. It had become entangled with it. Price crashes affected household balance sheets. Mining strained local energy grids. Capital flows influenced currency stability in smaller economies. At the same time, blockchain infrastructure quietly lowered costs for remittances, settlement, and financial experimentation. Economically, crypto had reached an unstable equilibrium. It was too large to ignore, too volatile to trust fully, and too decentralized to control easily. Its impact was neither purely disruptive nor purely speculative. It was uneven, cyclical, and deeply dependent on broader macroeconomic conditions, interest rates, liquidity, and risk appetite. In Segment 5, we'll step back and analyze crypto through a classical economic lens: scarcity, money theory, inflation, and whether Bitcoin and related assets function more like currencies, commodities, or something entirely new. By the time cryptocurrency became economically significant, a deeper problem emerged, one that markets, regulators, and economists still struggle to resolve. Crypto did not fit cleanly into any existing category. It behaved like money in some contexts, like a commodity in others, and like a speculative financial asset in most. Understanding crypto's economic role requires stepping back into first principles: what money is, how scarcity works, and why societies assign value in the first place. Traditionally, money performs three core functions. It acts as a medium of exchange, a unit of account, and a store of value. Most national currencies perform the first function reasonably well, struggle with the second over long time horizons, and perform the third unevenly depending on monetary policy and inflation. Commodities, by contrast, often perform well as stores of value, but poorly as media of exchange. Financial assets perform neither role directly, but derive value from expected future cash flows. Bitcoin does not fit comfortably into any of these buckets. As a medium of exchange, Bitcoin is slow, volatile, and costly compared to modern payment systems. As a unit of account, It is rarely used. Prices are still denominated in national currencies. Where Bitcoin stands apart is as a store of value, but even here, the story is complicated. Bitcoin's defining economic feature is enforced scarcity. Its supply is capped, issuance is predictable, and no authority can alter these rules without consensus from a network. In classical economic terms, this resembles a commodity more than a currency. Gold, like Bitcoin, is scarce, difficult to produce, and not tied to the health of any single issuer. But unlike gold, Bitcoin's scarcity is synthetic. It is enforced not by physical constraints, but by cryptographic rules and economic incentives. This raises an unusual question. Does scarcity still function if it exists only by agreement? So far, markets have answered yes, conditionally. Bitcoin's value is anchored not in utility alone, but in credibility. As long as participants believe the rules will hold, scarcity persists. If that belief collapses, so does the economic foundation. This makes Bitcoin's scarcity unusually brittle compared to physical commodities, but far more transparent than fiat money. From a monetary theory perspective, Bitcoin represents a return to hard constraints in a world accustomed to flexible supply. Central banks expand and contract money supply to stabilize employment, inflation, and financial systems. Bitcoin rejects this entirely. Its monetary policy is static, indifferent to economic conditions, and blind to demand shocks. This rigidity produces a distinctive economic behavior. In periods of rising demand, price must adjust upward because supply cannot respond. In downturns, there is no monetary expansion to cushion collapse. Volatility is not a temporary flaw, it is a structural outcome. That volatility is why Bitcoin struggles to function as everyday money. People do not like spending assets they expect to appreciate, nor holding assets that may lose half their value in months. Instead, Bitcoin behaves more like a speculative store of value, a digital asset whose price reflects long-term expectations rather than short-term utility. Other cryptocurrencies attempted to solve this by abandoning hard scarcity. Some introduced elastic supply, algorithmic stabilization, or governance-controlled issuance. In doing so, they move closer to traditional monetary systems, but also reintroduce trust and discretion, the very elements Bitcoin was designed to eliminate. This trade-off sits at the heart of crypto economics. Systems that prioritize stability require governance. Systems that prioritize decentralization sacrifice adaptability. There is no free lunch. Each design embeds a philosophy about who should absorb economic shocks, users, issuers, or the system itself. From an inflation perspective, crypto presents a paradox. Bitcoin is often described as an inflation hedge because its supply cannot be expanded. Yet its price is highly sensitive to global liquidity conditions. When central banks tighten policy, speculative capital retreats, and Bitcoin often falls alongside risk assets. In practice, Bitcoin behaves less like an inflation hedge and more like a long-duration bet on monetary instability. This does not make it meaningless. It makes it conditional. Economically, crypto is best understood not as money replacing money, but as a new asset class expressing skepticism about existing monetary systems. Its value rises when confidence in institutions weakens and falls when stability returns. It is not an alternative economy, it is a pressure gauge. By this stage, the crypto ecosystem had revealed a core truth. Blockchain can enforce scarcity, but it cannot enforce demand. Code can create rules, but it cannot create belief. Value still emerges socially, even when infrastructure is decentralized. In Segment 6, we'll examine the costs of this system, energy use, environmental impact, scalability limits, and whether crypto's economic trade-offs justify its resource intensity. By the time cryptocurrency reached global awareness, one criticism began to dominate public discussion: cost. Not price volatility or speculation, but resource consumption. In particular, the energy required to secure proof-of-work blockchains became a focal point for economic, environmental, and political debate. To understand this cost, it's important to be precise about what the system is paying for. In Bitcoin, energy is not a side effect, it is the mechanism. Proof of work deliberately converts electricity into economic security. The computational difficulty that miners compete against is what makes rewriting the ledger prohibitively expensive. Remove that cost, and the system collapses into something that can be cheaply attacked or quietly controlled. From an economic standpoint, Bitcoin externalizes trust costs into energy costs. Traditional finance secures trust through institutions, buildings, employees, regulators, compliance departments, courts, and enforcement agencies. These costs are diffuse, opaque, and funded indirectly through fees, taxes, and inflation. Bitcoin concentrates those costs into a single visible input, electricity. This visibility makes the system easier to criticize, but not necessarily more expensive in absolute terms. The relevant economic question is not whether Bitcoin uses energy, but whether the energy used produces sufficient value relative to alternatives. Here, opinions diverge sharply. Critics argue that proof of work consumes vast amounts of electricity without producing tangible output beyond ledger maintenance. Supporters counter that secure, censorship-resistant settlement is itself the output, and that global finance already consumes enormous energy through data centers, office towers, transport, and redundant institutional infrastructure. What makes the debate difficult is that Bitcoin's costs are marginal and global, while its benefits are unevenly distributed. For a user in a stable financial system, Bitcoin may appear redundant. For someone facing currency collapse, capital controls, or confiscation risk, the cost may be justified. Energy economics further complicate the picture. Bitcoin mining is uniquely mobile. Miners are incentivized to seek the cheapest possible electricity, which often means surplus, stranded, or intermittently wasted energy. Hydroelectric overflow, curtailed wind power, flared natural gas. These sources are economically inefficient without a buyer that can operate anywhere and shut down instantly. In practice, this has turned Bitcoin mining into a buyer of last resort for certain energy markets. In some regions, it stabilizes grid economics. In others, it exacerbates scarcity and raises prices. The outcome depends less on the protocol and more on local regulation and infrastructure planning. Scalability introduces a separate cost dimension. Bitcoin intentionally processes a limited number of transactions per second. This constraint preserves decentralization by keeping node operation cheap and accessible. But it also means the system cannot scale like conventional payment networks. As demand rises, transaction fees increase, pricing out low-value transfers. Economically, this forces a layered architecture. Bitcoin functions as a settlement layer rather than a retail payment system. Secondary networks and custodial solutions absorb transaction volume, reintroducing intermediaries but reducing cost. This mirrors how central bank settlement systems underpin commercial banking rather than replacing it. Other blockchains attempted to solve scalability by increasing throughput or abandoning proof of work entirely in favor of proof of stake. These systems dramatically reduce energy consumption, but they introduce new trade-offs. Security shifts from physical cost to financial stake. Control concentrates among large token holders. Governance becomes more explicit and often more political. From an economic lens, there is no universally superior design, only different allocations of risk. Proof of work spends energy to minimize trust. Proof of stake minimizes energy by concentrating influence. Faster chains optimize efficiency at the expense of decentralization. Slower chains preserve decentralization by accepting higher friction. The deeper issue is that crypto exposes costs that legacy systems obscure. When trust is embedded in institutions, its maintenance is invisible. When trust is embedded in computation, its price is measurable. This makes crypto uncomfortable because it forces societies to confront how much they are willing to pay for neutrality, censorship resistance, and independence from discretionary authority. By segment 6, the pattern should be clear. Crypto does not eliminate economic trade-offs. It relocates them. It replaces political discretion with technical rigidity, institutional opacity with computational cost, and adaptive policy with fixed rules. In Segment 7, we'll turn to the consequences of those trade-offs: inequality, wealth concentration, early mover advantage, and whether crypto meaningfully democratizes finance or quietly reproduces its existing hierarchies. One of the most persistent claims surrounding cryptocurrency is that it democratizes finance. By removing intermediaries, lowering barriers to entry, and operating without permission, crypto is often framed as a leveling force, an economic system where anyone can participate on equal terms. The reality is more complicated. From the beginning, crypto has existed in tension between openness and advantage. In principle, anyone can download software, run a node, generate cryptographic keys, and transact on a blockchain. There are no formal gatekeepers. But economic outcomes are shaped not just by access, but by timing, capital, information, and risk tolerance. On these dimensions, crypto has been uneven from the start. Early participants in Bitcoin faced extreme uncertainty. Mining and acquiring Bitcoin when it had little or no market value carried technical and reputational risk. Those who participated early were compensated for that risk through outsized returns. Over time, these early advantages compounded. Large holders gained influence, liquidity, and the ability to absorb volatility that late entrants could not. This is not unique to crypto. It mirrors early industrial capitalism, venture investing, and technology adoption more broadly. What makes crypto distinct is that wealth distribution is unusually transparent. Blockchain ledgers reveal concentration directly. A small percentage of addresses control a large share of total supply. While not all addresses correspond to individuals, the pattern is unmistakable. Mining economics reinforce this concentration. As competition increased, mining shifted from individuals to industrial-scale operations. Capital intensity rose. Access to cheap energy, specialized hardware, and favorable regulation became decisive. What began as a decentralized activity evolved into an industry dominated by a small number of players with significant influence over network security. In proof-of-stake systems, concentration emerges through different mechanisms but leads to similar outcomes. Influence flows to those with the largest holdings. Governance votes are weighted by stake. Returns compound automatically. Economic power begets protocol power. At the same time, crypto created new forms of inclusion. Individuals excluded from traditional banking systems gained access to global financial infrastructure using only a smartphone. Remittances could bypass costly intermediaries. Savings could be held outside fragile national currencies. These benefits were real, but they were unevenly distributed and often fragile, depending on volatile markets and unreliable platforms. The promise of decentralization also collided with human behavior. Many users preferred convenience over sovereignty. They stored assets on centralized exchanges, delegated custody, and trusted platforms that resembled banks in all but regulation. When those platforms failed, losses were often total. Decentralization existed at the protocol level, but not at the user level. This gap exposed an uncomfortable truth. Decentralization is cognitively and operationally expensive. Managing private keys, understanding smart contracts, and navigating irreversible transactions requires technical literacy and discipline. Those without these resources often gravitated toward intermediaries, reintroducing the very risks crypto sought to remove. From an economic standpoint, crypto did not eliminate inequality. It reshaped it. Advantages shifted toward those with early access, technical expertise, capital, and tolerance for volatility. The system remained open, but outcomes were not equal. This does not invalidate crypto's thesis. It reframes it. Crypto democratizes access to financial infrastructure, not financial outcomes. It offers tools, not guarantees. Markets still reward risk-taking, information asymmetry, and scale. By segment 7, it becomes clear that blockchain is not inherently emancipatory or exploitative. It is a neutral substrate that amplifies existing economic dynamics while removing certain institutional constraints. Whether that leads to broader inclusion or deeper concentration depends less on code and more on education, governance, and surrounding economic conditions. In segment 8, we'll examine the regulatory response, how states have reacted to crypto, why control remains difficult, and how regulation may ultimately shape the future of blockchain more than technology itself. As cryptocurrency moved from the margins of the internet into the global economy, states were forced to respond. Money, after all, has always been a central concern of governments. It underpins taxation, monetary policy, capital controls, and national security. A financial system that operates outside formal oversight is not just a technical curiosity, it is a political challenge. The initial regulatory reaction to crypto was confusion rather than opposition. Existing legal frameworks were not designed for assets that were simultaneously currencies, commodities, payment networks, and software protocols. Regulators struggled with basic classification. How crypto was defined would determine which agencies had authority, what rules applied, and whether participation was legal at all. This uncertainty created a fragmented global landscape. Some jurisdictions attempted to ban cryptocurrency outright, framing it as a threat to financial stability or capital controls. Others embraced it cautiously, seeing an opportunity to attract investment, innovation, and talent. Many adopted a reactive posture, intervening only after major failures or consumer harm. From an economic perspective, this fragmentation mattered more than any single regulatory decision. Crypto is inherently mobile. Capital code, and users can relocate faster than legislation. Projects migrated to favorable jurisdictions. Exchanges shifted operations. Regulatory pressure in one country often resulted in activity moving elsewhere rather than disappearing. At the same time, states discovered the limits of enforcement. While centralized exchanges and custodians could be regulated, licensed, or shut down, decentralized protocols could not be easily targeted. Smart contracts had no headquarters. Public blockchains had no CEO. Enforcement increasingly focused on access points, fiat on-ramps, stablecoin issuers, and custodial services, rather than the protocols themselves. This produced an asymmetric outcome. Highly decentralized systems remained resilient, but users interacting with them through centralized platforms remained exposed. Regulation did not eliminate risk, it redistributed it. Governments also faced an internal contradiction. On one hand, crypto threatened monetary sovereignty by enabling capital to move freely and anonymously across borders. On the other hand, the underlying technology offered tools that states themselves could use: programmable money, transparent settlement, and improved financial infrastructure. Central banks began exploring digital currencies inspired by blockchain architecture, even as they resisted decentralized alternatives. This coexistence highlighted a key distinction. States were not opposed to digital money. They were opposed to losing control. From a policy standpoint, the hardest problem was not criminal activity or consumer protection. It was scale. If crypto remained small, it could be tolerated. If it grew large enough to influence credit creation, monetary transmission, or systemic stability, it would demand intervention. Regulatory pressure increased during market downturns when failures exposed leverage, fraud, and mismanagement. In these moments, the absence of deposit insurance, lender of last resort functions, and disclosure standards became politically unacceptable. Calls for oversight intensified. Yet enforcement remained selective and uneven, often targeting intermediaries rather than infrastructure. Economically, regulation introduced a new variable into crypto markets: jurisdictional risk. Asset valuations began to reflect not just technical merit or network effects, but legal uncertainty. Projects that aligned with regulatory expectations gained institutional capital. Those that resisted faced exclusion from mainstream finance. This dynamic gradually reshaped the ecosystem. Fully permissionless systems persisted, but much of the industry gravitated toward compliance. Decentralization became more of a spectrum than a principle. The original vision of crypto as a parallel financial system gave way to a more pragmatic reality, coexistence with the state on negotiated terms. By Segment 8, it becomes clear that crypto's future is not determined by code alone. Economic incentives, political authority, and legal frameworks exert gravitational pull. The technology can resist control, but it cannot escape interaction. In Segment 9, we'll assess crypto's real-world economic impact today, where it has delivered meaningful value, where it has failed, and what remains unresolved after more than a decade of experimentation. After more than a decade of development, speculation, collapse, and reinvention, cryptocurrency invites a sober question. What has it actually changed in the real economy? Stripped of ideology, hype, and marketing narratives, crypto's impact is uneven, situational, and far narrower than its most ambitious claims, but not trivial. The most durable contribution of crypto has been in settlement. Public blockchains demonstrated that value can be transferred globally without intermediaries, with finality enforced by protocol rather than institution. This is not revolutionary for retail payments in stable economies, where existing systems are already fast and cheap. But in cross-border contexts, the difference is material. Remittances, offshore transfers, and settlement between institutions can occur faster and at lower cost, particularly where legacy infrastructure is weak or exclusionary. Stablecoins represent the clearest economic bridge between crypto and traditional finance. By combining blockchain rails with fiat-denominated value, they allow dollars and other currencies to move outside the banking system without abandoning price stability. This has had measurable effects in regions with capital controls, fragile banking systems, or high remittance costs. In these contexts, crypto is not replacing money, it is replacing plumbing. At the same time, many of crypto's most visible applications have failed to deliver durable economic value. Decentralized finance promised to disintermediate lending, trading, and asset management. In practice, it often recreated existing financial structures with higher volatility, lower consumer protection, and heavy reliance on speculative incentives. Yield was frequently subsidized rather than generated, sustained by token emissions rather than productive activity. Similarly, the explosion of tokenized assets, non-fungible tokens, and algorithmic financial products produced moments of innovation but little lasting integration with the broader economy. These markets were highly sensitive to liquidity conditions and collapsed rapidly when speculation retreated. Their economic footprint shrank dramatically once subsidies disappeared. From a labor and productivity standpoint, crypto has not yet delivered broad gains. It has created new industries, mining, exchange services, custody, compliance, development, but these remain small relative to the global economy. Productivity improvements have been localized rather than systemic. Where crypto has been most influential is cultural and institutional. It forced central banks, regulators, and financial institutions to confront long-standing inefficiencies in settlement, transparency, and access. It demonstrated that programmable money is feasible. It accelerated discussions around digital identity, payment infrastructure, and monetary design that might otherwise have moved slowly. Yet crypto also revealed its limits. It did not eliminate trust, it redistributed it. It did not remove intermediaries, it changed who they were. It did not escape cycles of leverage and collapse, it amplified them under certain conditions. Markets remained human, emotional, and prone to excess. Importantly, crypto's economic relevance has proven countercyclical. Its influence grows during periods of institutional stress and recedes during stability. This suggests that crypto functions less as a replacement system and more as an adaptive layer, a financial pressure valve that becomes attractive when confidence erodes. By this stage, the core picture is clear. Crypto succeeded technically, partially succeeded economically, and failed rhetorically. It did not transform the economy wholesale. It exposed constraints, tested alternatives, and revealed where existing systems remain brittle. In Segment 10, we'll close by looking forward, what remains unresolved, what paths are plausible over the next 20 years, and whether crypto's long-term role is foundational, peripheral, or transitional. By the time blockchain and cryptocurrency reached maturity, one conclusion became unavoidable. Crypto was never a singular solution to economic dysfunction. It was an experiment, one that revealed possibilities, exposed constraints, and clarified trade-offs that had long been hidden inside traditional financial systems. The original promise of cryptocurrency was radical. It imagined money without states, settlement without institutions, and trust enforced entirely by code. Technically, much of this worked. Public blockchains proved resilient. Bitcoin continued operating without interruption. Smart contracts executed as designed. Decentralized systems survived stress that would have crippled centralized platforms. Economically, however, the picture is more restrained. Crypto did not replace national currencies, nor did it meaningfully weaken state control over monetary policy. Governments retain the ability to tax, regulate, and enforce. In moments of crisis, people still fled towards state-backed liquidity, not away from it. The gravitational pull of legal tender remained dominant. What crypto did accomplish was narrower and more durable. It introduced credible monetary alternatives that could exist without permission. It forced financial institutions to modernize settlement infrastructure. It demonstrated that scarcity, transparency, and programmability could be enforced without centralized authority. These ideas did not remain confined to crypto. They diffused outward. Over the next decades, crypto's most likely trajectory is not dominance, but integration. Bitcoin may persist as a non-sovereign store of value, an asset held not for everyday use, but as insurance against institutional failure. Other blockchains may serve as settlement layers for niche financial markets, cross-border transfers, or automated agreements where traditional systems remain inefficient. At the same time, states will absorb the lessons. Central bank digital currencies will borrow blockchain concepts without adopting decentralization. Regulation will continue shaping crypto into forms that resemble existing finance, with familiar protections and familiar compromises. The more crypto interacts with the real economy, the less radical it becomes. This does not mean the experiment failed. Crypto succeeded in making economic assumptions visible. It forced questions about who controls money, how trust is enforced, and what trade-offs societies are willing to accept. It revealed that decentralization has costs, that neutrality requires sacrifice, and that automation cannot replace governance, only relocate it. Perhaps the most important legacy of crypto is not any specific asset or protocol, but the shift in imagination it produced. Money is no longer seen as fixed infrastructure. It is understood as a design choice, one that can be encoded, audited, challenged, and reconfigured. In that sense, crypto's lasting impact may be philosophical rather than financial. It widened the design space of economics. It showed that alternatives are possible, even if they are imperfect. The experiment continues, but the illusions have fallen away. What remains is something quieter, smaller, and more honest, a set of tools, a set of trade-offs, and a reminder that no system escapes economics, only rearranges it.